YouTubers, Mike Martin's here. Mike Martin's channel. 40-year mortgage means lower monthly repayments, but ultimately it's advantage to the lender. Hey, let's pay our house back 6 times. By the time it's paid off, yeah, we'll pay 6 times the balance. I think 3 or 4, actually, if you want to get really technical with the math here. So this is reported 5 hours ago. Sent to me by my Sydney friends down in Australia. If you think 25 or 30 years is a long time to pay off your home, how about 40? That's right. So the average person that does take out a mortgage is 21 to 27, back in like when the youth would be getting into the housing market, the young blood. By the time you pay it, to be 40, 57, 40, 50, 67, 70. I guess that's a good time to look for retirement and have your house paid off, right? But how many people actually pay their houses off, nowadays? That's right, a handful of lenders will let some borrowers take up to 40 years to pay off their mortgage. Financial product comparison website Rate City says there are currently half a dozen lenders in its database that offer 40-year home loan terms. 4 of them customer-owned credit unions or mutual bank, which fall under the supervision of banking regulator APRA because they take deposits, while the other 2 are among the larger non-bank lenders. Guys, remember what I told you about when you do the amortization and when you do you have your term, 4, 5, 6-year term, and then you have your amortization. So when you amortize it over 40 years, if you paid, if you do the math and you paid an extra $7 a month, you bring it down to 37 years. If you pay an extra $30 a month, you bring it down to 32 years. And if you pay an extra $110 a month, you bring it down to 30 years. Look at your amortizations before you sign something for 40 years. Do your own research, okay, guys? None of the major banks offer these 40-year maximum loan terms, nor its growing trend in Australia. But the first time home buyers are turning to these loans to try and get a foothold in the property market that remains expensive despite recent price falls. Uprisingly, 40-year mortgages are targeted at first home buyers who have time on their side to pay down their debt, but don't quite have the serviceability power to successfully get the 30-year home loan application over the line. Rate City's research director Sally Tidley said, "You know what I'd ask for, guys? I'd ask for this. If I was going to sign a 40-year amortization, I would actually ask if it's open for extra payments. Can I be allowed to make extra payments on this mortgage? If they say no, you could make extra payments when it comes to term. So your 4-year term is up, and then you're going to re-sign. Try and save $100 a month or $200 a month on the side. So when your 4 or 5 years is up with your term, and you're going to re-amortize it, I would put all that money lump sum you put down on the principal and then refinance. That's a way of doing it. Don't take my advice. Do your research." The serviceability power Tyndall is talking about, it's whether the borrower can comfortably afford their monthly repayments. When the mortgage is spread over a longer term, those monthly repayments are smaller than they would be on a shorter term, making them more affordable. No, but you're paying more and you're paying longer, guys, so pay attention. But as Andy, the investigations editor with Consumer Group Choice, points out that this current affordability comes at a long-term cost. Yet you pay more, right? The longer the loan, the lower the monthly payment, so stretching the mortgage over 40 years may put the loan within the range of affordability, he said. But, of course, the converse is also true. The longer the loan, the more interest you pay in the long run. So remember, guys, you're paying VIG on this. VIG, V-I-G, or juice, or underjuice, or undercurrent, or interest. You would pay almost double that interest of hundreds of thousands of dollars more with a 40-year loan as compared to a 25-year loan, so the advantage ultimately goes to the lender. So here it is. Here's your 30-year, $400,000 interest rate, 4%, and there's your interest rate at 5 points right there on a 30-year. And this is what you're saving here from 30 to 40. So you got that gap there. See that? Right? And there's the difference. So that's all the difference you have to pay to make up that gap that I told you at the beginning of the video. Total repayments. Holy crap! So it's 3 or 4 times the average principal. Wow. Wow. Australian banks shy away from 40-year loans. So now they're shying away. And this is an older article here. So that was the first article. I wanted to show this to you guys. Guys, be careful with the 40-year term, please. No, 4-year term. 30-year amortization, 20-year amortization, I would strongly recommend to stick with the 25 or 30-year amortization. And if you stick with if you have to take the 40 to get you through the stress test, I recommend, this is what I'm recommending, do your own research, okay? I recommend to ask if you can make extra payments on it, so when you get a little bit of extra tax return or a little bit of nudge at pay, to start paying down that principal fast. Let me know what you guys think in the comments below. Thanks for watching, and don't forget to hit the subscribe button or support me on Patreon. Thank you, guys.